All
Check,
right, man.
check.
Happy Tuesday.
Hello and happy Tuesday, the 2nd of May. Shall we stay or go away? Is
That's a great
today.
question. That's the question, right? Sell in
Yeah,
May and go away. I've heard people say this for a very long time, and I wanted to kind of do a quick overview of that today. Why do people say that, and does it matter in crypto?
very interesting that we're talking about this concept that for a long time was somewhat, you could call it like a guiding. I would argue that it has been in the past, it probably still is for a lot of people that are very steeped in markets, especially traditional finance. And what I mean by that is simply the stock market or stock markets around the world. And the this new paradigm or there's a couple of interesting things that have happened, and I'll get into those in a second. And they have to do with the shift from traditional Monday through Friday market hours as we learned them to be in previous years and decades and epochs of the existence of the stock market. But going back in time, what I'm trying to communicate is that markets, there were market hours and then everything else. And when the markets were open, there was participants and therefore volume, but trading volume is what I'm getting at. So that's one like important piece of the equation here, or piece of this puzzle, is the understanding of like the importance that volume plays in driving price action. And really you can extrapolate perhaps, and maybe that's not the right word, but I'll just use it. You can extrapolate that volume has to do with participants, and if participants have gone away in the month of May, which we'll talk about in a second, that it's not a great time to be speculating on the price of different types of assets, whether they're stocks or commodities or bonds or nowadays crypto. But things have been changing, and there's a big difference now between the old days when market hours ruled everything, and if it wasn't market hours, you couldn't even participate. You couldn't even take any risk. So now, with this shift that began many moons ago, with this idea of 24/5, I mean 24 hours a day, 5 days a week for trading. Now we've got 24/7, and crypto was the tip of the spear, I think, that like got us into this 24/7 world of ability for market participants to show up, put their money to work slash at risk any day of the week throughout the whole year. And then the other interesting variable in the equation is with the proliferation of the internet. It's now global, and the sun never sets on trading activity, especially in the cryptosphere.
No, I think those are two important points, right, to consider because, especially the global aspect of this, right? If you're talking about the U.S. stock market, yes, there's global participants, but crypto is a whole different animal. And so when we talk about sell in May and go away, I've just heard this so many times, and I always kind of laugh because in my head I think, all right, well, all the big money guys must just go to the Hamptons and stop caring for the summer, right? Must be nice. I guess I would like to, that'd be nice to live that life, But what we're saying is that traditionally volume drops off in the summer in traditional markets, and that's the idea behind sell in May and go away. And you're talking too from mostly a trading perspective.
Yeah, there's a book that I was turned on to early days in my career, in my trading journey. I won't even call it a career because I barely broke even. I was not break even. I was barely break even, meaning I was not break even. Okay, for many years. Okay, part of the journey. Former big boss at the fund. When I first met him and told him this is what I'm interested in doing, and he was like, "Oh man, here we go." Like here's another one of these kids. Anyway, he told me you need to read this book called Reminiscences of a Stock Operator. And if you just Google for stock operator and don't worry about spelling reminiscences of, then you'll find this. And there are several instances in this book where the trader that this tells the story of, there were periods of time where he would literally close out all of his positions, and then go on vacation for months. And it was the classic sell in May and go away. And what I think what that saying comes from is that given there's going to be this period of very low volume, the market has no direction, and it will oscillate and gyrate, and the volatility, like there's no trending market up or down that you can reasonably rely on. And so what he would do is he would disappear, literally go away, disappear for 2-3 months at a time, and then come back. And the thing that I remember very vividly is thinking is, given the experience that I had to date in my trading journey at that time, I felt like I had to be plugged in and understanding what's going on based on what the economic calendar was saying, and all of these macro levers and all these concepts, like what the central bank policy, the monetary policy, and then for each country and how it was going to affect us. We were commodities, futures, currency, futures traders, interest rate futures traders, and I was supporting them, blah, blah, blah. Anyway, the point is that the idea of stepping away just for the weekend was hard enough for me to get, like, as I would come back on Monday and try to like figure out like what the heck is going on in this world that we live in, which is even nuttier now by many metrics. But the point I'm trying to get to is that it always astonished me reading this, that this dude would go away, according to the story, and then come back months later and then just get right back into putting money taking risk in the market by putting on trades. And I guess I admired that dude's confidence. Is what I'm trying to say.
Well, yeah, I mean, it's confidence, but it's also knowledge of how markets work, right? And that's the thing, too, to always remember that, when you're trying to get involved in this journey. I mean, there's a lot of different ways you can do it, right? We always talk about trading versus investing, and if you're trading, you really do want to have a good understanding of how markets work, and you want to try to understand who you're trading against, right? And so the concept of sell in May and go away is interesting to me. I don't particularly know that it applies to crypto. What are your thoughts, Ted? I mean, there's probably some truth to that, but I mean, we'd have to go back and look at volumes, right, in the short 12-year history of Bitcoin. And I didn't have a chance to pull it up before we talked today, but what I did pull up was, let's see, we've got a little chart here showing the percentage moves in Bitcoin since 2013. Now, granted, this only goes to 2022, but you can kind of get a look at here. Let me move this up a little bit. Oh, it's stuck on the screen. So.
Oh yeah, that overlay thing is probably stuck based on. Anyway.
Well, you get the idea, right?
The thing I wanted to throw in real quick is that there are a lot of traditional TradFi or traditional finance types that participate in the crypto markets. And just like when you pick up and move from one state to another, you take your beliefs with you, okay? And whatever market you're trading, and as Van Tharp would say, esteemed and distinguished trading educator, also very successful trader, period, would say you don't trade markets, you trade your beliefs. So what I'm trying to communicate here is that there is a belief, and I'll quote something from a site called beincrypto.com. This was from April 2023, it looks like. Basically, the quote unquote sell in May and go away is a popular saying in the business and finance industry that suggests a strategy for investing in stocks. However, it can also be used in crypto markets. This is what the author of this article says. And the last statement is this, and this is what applies, or what people who read this or people who subscribe to this ideology probably like is a part of their beliefs, is that the idea is that the stock market tends to perform poorly during the 6 months during May and October, and that because of the relatively poor performance between May and October, the least riskiest move is or the least riskiest position is to have no position in stocks or other assets. It's to have a position in all cash. So your positioning is what gives you the opportunity to either make money or lose money. And if you're positioned during May and October in cash, then you're, according to this theory, And this ideology is that you're better positioned during that period, because the performance is just not, the juice is not worth the squeeze, and the risk is not worth taking, is what some people think.
No, that's interesting. It makes a lot of sense, and it goes back to, again, what is your investment strategy, right? If you're investing for, you know, 2 to 5 years or 10 years and longer, none of this matters, right? The only way you can use this in that strategy is to kind of plan some of your dollar cost averaging buys. If your belief is that markets will be slower in the summer, maybe you can up, some of your daily or weekly buys into this asset that you're going to plan to hold for 5 or 10 years, right? That's a one way to look at it.
Yeah, I tend to agree. And what I'll supplement what you're talking about there is that in a 2 to 5 to 7 or 10 year, really, maybe let's call it just call it 5. If on average the market, I'll just pick the S&P. If we're in a bull market, okay, a bull market phase or trend, and you look at the last 3 years of performance, and on average, the S&P went up, say, 10%. Let's just make the math easy. If it's going up 10% on average a year, meaning maybe it went up 11% one year and 9 the previous, and then 12 this year and maybe 10 this year. The point of the thing to understand is that you can in an uptrend, you can, on January 2nd or whatever the first day that the market opens for that new year, you could take a lump sum and say, put it all on the S&P 500, or put it all on the NASDAQ, or put it all on the Dow, whatever. Stick with S&P because that tends to be the benchmark in traditional finance world. If you're not making at least the return of the S&P, then you're losing money, is the saying. The point I'm trying to get to is that you could, at the beginning of the year, bet it all on S&P 500, go away for the whole year, and at the end of the year, you were up 10%. You didn't have to participate in any of the wild gyrations. You didn't have to sit and wonder and lose sleep at night if you were positioned the wrong way from May until October, with the volume leaving the market and participants doing other things, and other people that are not say as seasoned as other traders trying to get in there and creating problems for themselves. Maybe there's I think what happens in crypto, because they're the last truly free markets, in my opinion, is you get a lot of people taking wild speculative bets, and they put on lots of leverage, and those positions get liquidated either to the upside or to the downside, and it creates a lot of price fluctuation and all this volatility. And what seems to fix that, we've learned from traditional finance, at least in my opinion, is that when there's a lot of volume, price action tends to stabilize. And the point I'm trying to get to is that, in summary, if you're on a 5-year time horizon, that on average the S&P goes up about 10% a year, you can just buy the S&P and go on vacation and not lift a finger and not sweat in the slightest, and come back 5 years later and look that you've earned on average about, your compound annual growth rate is X%, and you didn't have to lift a finger. You didn't have to take short-term risk by moving in and out of positions, and then more importantly, paying. Every time you transact, the tax man shows up and wants their cut. So that's really what I think. Like, one way to look at this concept and think about how it may or may not affect you is that, depending on your time horizon, it probably plays no bearing on what you will do, or more importantly, what you won't do. And meaning you're not going to be moving in and out of positions trying to capture profit, when you could just literally sit back and watch for an entire year and get your average 8 to 12%.
Yeah, and I think that's why most people use brokers, right? And they use money managers, because they think, okay, well, I really don't have the time, and I really don't want to move in and out of the market. I don't want to learn the markets. It just doesn't apply to me. Unfortunately, though, things are changing, right? And that this strategy, especially over the past year with interest rate hikes, has become something that may or may not work as well as it has in the past. And the reason anybody does any of this, for the most part, the main reason is you got guys that are really good at this, that they make a really good living doing this. But the other reason is you have to have your money invested to try to beat inflation, right? And so you've got the situation where if you don't earn 7 to 10% annually on your money, you're not keeping up with inflation. And that's a problem that this all circles back to, like, why should anybody care about this? Well, if with crypto and especially Bitcoin, you could take the same approach, right? And you could just say, look, I don't want to think about all this shit. I don't want to worry about it. I don't want to make trades. I don't want to be in and out. I don't want to learn the crypto markets. I just want to allocate X% to Bitcoin. And over 5 years, the average, what do they call it? A CAGR, compound annual growth rate. It's up 150%. Now, that's going to change, as these markets mature and more money comes in. I don't think we're going to see 5-year CAGRs of 200, 300% forever. But what if you had even 30%, right? That's huge. And that's kind of a way why it matters to cryptos, because you can take that approach that you put into, giving money to a broker or a money manager and trying to make 10% a year. Now you're going to have to put up with some volatility in this, and this is the volatility is your friend here, right? In the long term, in the short term, you're going to sweat a little bit, and that's why I think crypto's important to people in this regard, because you can essentially accomplish the same thing, meanwhile controlling your own assets and not being subjected to, some of the factors that happen in traditional markets. That being said, though, we are still extremely correlated to these traditional markets, unfortunately. I think at some point that does change. I think we're too new, too young, too small. I think, what are we at, $1.5 trillion? Let me look here. Total market cap for crypto here. Where is this? Yeah, it's 1.21 trillion. That's nothing in terms of the total money supply. But you get the idea. You get kind of what I'm saying here, the general direction I'm going with this.
Yeah, the last thing I wanted to say on the CAGR, CAGR, the compound annual growth rate, is that if you want to look, or it would do you well, in my opinion, to get on Twitter and find Michael Saylor's account at Saylor, and SAY, not SAI. The part I'm going to get to is he shows, or he's talked about the compound annual growth rate, and look, did a little dig in here. It looks this article that I'm reading briefly is published earlier this year, April 30th. Consolidated returns, April 30th. So not very old at all, and was updated yesterday. Okay, great. It says that in the last 10 years, Bitcoin has obtained a 73.32% compound annual return.
That's
73% compound annual growth rate for the last decade. Now, if you look at what Bitcoin started trading at early days, what it traded at in previous bull runs, and where it most recently traded at its highs, and then how it has pulled back and retraced back to where we are today at a most humble 28,204 at the moment. There's two ways to look at this. Is that, oh my gosh, Bitcoin used to trade at 67,000, now it's only 28. It's over. We should all pack up and go home and forget sell in May, sell forever and never come back. That's one way to look at this, and that, oh my gosh, it's the end of the world. But if you bought some Bitcoin 10 years ago and just sat on it, you would have made 73% compound annual growth rate. And that beats the living pants off of many other things. And we don't have to, we can maybe do some analysis on how it has outperformed, but that's a decades long outperformance, in my opinion, or that's a hell of a run, as they would say. The other thing I wanted to point out is that on a much shorter time frame, we look at what Bitcoin started trading at the beginning of the year. We started at, what was it, like 16,000 or 19,000? Oh, hold on, I can tell you. So January 1st, January 2023, the low was 16,490, and we're at 28,000 for the year. And the point I'm trying to get to is that if you look at look at the performance just this year, it's outperformed virtually everything. Now, don't quote me on that, or take that with a grain of salt, and say do your own research. Not financial advice here, of course, but look at how just in the first quarter and into the second quarter, the rate that it moved, that the volatility that went to the upside, that drove price went to the upside as a result of the volatility in the market this first quarter, which was on the heels of the volatility in the market last year that heavily suppressed the price. The volatility is enough to make a lot of people sick and sweat on the short term, but still, given everything that has happened, especially last year and especially in previous Mount Gox's and all these other like borderline catastrophic extinction level events that would have crushed and destroyed other things, Bitcoin and crypto in general did not die. And I get a kick every time I see the Twitter account that says it's the Twitter account, did Bitcoin die today? And the answer is always, the tweet is always no.
Well, yeah, and when you look at this stuff too, if you're a critic of what we're saying, you'll say, yeah, Josh, yeah, Ted, that's great, but in 2022 it was down, 70-80%. Well, that's your time frame is a year, and you're going to have that volatility, but because the volatility works in both ways, over time you're able to achieve that 73%. And when I look at CAGR and Bitcoin, it's hard for me to kind of say, okay, yeah, 73%, but when it started at 1 cent and went to the first year or two of Bitcoin, if that's factored into that, that's not going to apply forever. But I think kind of what we have to remember here is that this asset class is unique in the fact that there is a limited supply. And so I think the thing that people have a hard time understanding is at some point, right, and it could happen for a number of reasons. It could happen in 2 months, it could happen in 5 years. That supply is going to become extremely scarce, right? And what happens then? And we don't know 100%, right? Maybe the idea of the Bitcoin maxis, which I would consider myself in this regard, as far as an asset class, Bitcoin's its own asset class, and then there's everything else in crypto that's a project and an experiment and a tech investment, right? Is kind of how you can frame it. But that's the interesting part that we don't know yet. What is this price going to do when scarcity truly kicks in? That's the thing. And so you think of this number as 28,000. Why is Bitcoin worth 28,000? Well, look, when this market cap grows to 10 trillion, the price of Bitcoin should be 500 grand, right? And that number seems crazy right now, but I remember in 2017 when I started, the idea of a $30,000 Bitcoin seemed absurd. And now it's just kind of like,
Exactly. Interesting thing I wanted to point out as we round this conversation, or we bring this back around. I'll start with this idea of supply, and I'll talk about Berkshire Hathaway, BRKA, the Class A shares, and what I'm driving toward here ultimately is this thing that people just don't get and don't want to believe. It's this idea of supply, like the amount of something, and what I want to try to illustrate. I'm going to bring up in my. Okay, you want to hear something absurd? I'll tell you what's absurd. Is that BRKA, Berkshire Hathaway Incorporated, Class A shares currently traded yesterday, 503,400 for one share of Berkshire Hathaway Class A stock. I remember when Berkshire Hathaway was trading at 200,000, and I couldn't believe it because it was almost as much as I paid for my house, my first house here in Florida. Basically, I remember when it hit 247,000, I laughed because I was like, oh, wow, I could have bought a share of Class A Berkshire Hathaway, or I could have bought the place to live and do my, have my life and have my things and have my internet and all that good stuff. And the point I'm trying to make is that what people don't get is that Berkshire Hathaway determines how many shares they issue. And if you're paying $500,000 for shares today, and let's say there's 100 million, or let's say there's 50 million shares. Let's say there's only 10 million shares, okay? And let's say there's only 10 shares. It doesn't even matter. The number of zeros on the end doesn't matter. You take the supply of circulating shares that are available today to trade on the market, and what happens if Warren Buffett wakes up one day in a fog of not having enough cherry Coke and not enough McDonald's cheeseburgers, and it's like, you know what? I want to issue 10 more shares. I want to double our number of shares that we have on the open market. What happens to the price of Berkshire stock? It drops by half because you literally increase the supply of shares. And the point is not any of the numbers. It's that the company determines the shares. And this happens all the time. Is companies issue shares and dilute the value of the stock right out from underneath their existing shareholders, for their own reasons and for their own benefit. And they tell people, you buy our shares, you buy our stock at your own risk. Now, there's certain things that go into, like when you're buying certain classes of stock, you get preferential treatment, and you get some, like Buffett definitely gets preferential treatment when he buys shares of another organization. He gets special stuff.
Well, he's got the juice. He's got the leverage to come in and say, hey,
that's right,
I'm interested, but I'm only interested here, right?
But the point is simply that the company that issues the shares controls how many shares they are that do exist. And people will buy stock any day of the week. Like there are people today that will get on Robinhood with no concern for the number of outstanding shares of Tesla, and they will just buy Tesla stock at any price. I'm not criticizing that. I think Tesla's great. Whatever. Do what you like. The point is that at what point does the average person nowadays think about, well, gosh, I really wonder what the float is. The float is the number of available shares to trade during a trading day, okay? How many shares are locked up? How many are available to trade? How many different classes of shares are there? How many shares of common stock? How many shares of preferred stock? How many senior notes are out there to be traded that you look at the capital structure of Tesla? Like, how many people are looking at the capital structure of an organization and understanding where they fall in the hierarchy or the pecking order?
Not enough.
Not enough. Okay. But the point is that Tesla, they do great stuff, whatever. They'll be around and whatever. My opinion doesn't matter. What does matter is that if they wanted to, they could issue more shares today, and they could dilute the value of the shares on the open market by doing so. This concept is key, because what most people don't get, and what the smart money hedge fund trader Wall Street types do get, is that whether they say this or not, Jamie Dimon's little dog and pony show at Davos talking about, how do we really know that Bitcoin's supply is limited? Oh, give me a break. You don't become the Jamie Dimons of the world by being an idiot and not being able to do basic math, or employing a team of people that will go and figure this crap out for you. That was the most embarrassing thing I've seen in a long time. I was just so embarrassed by that. The point I'm trying to get to is that we know mathematically, Michael Saylor will back this up, and he's put his money where his mouth is to the tune of billions of dollars worth of Bitcoin, is that the Bitcoin's supply is mathematically limited, and it is controlled by no person, and there will only ever be a certain amount of this. So now take this concept and start thinking in terms of the demand side of it and the supply side of it. And if you know that the supply will never extend beyond a certain threshold, meaning it'll never be more than this much Bitcoin ever, and 92% of it already exists in the supply pool, and it will take until 2140 for the rest of it to show up, meaning that anyway, I don't want to take us off track here. Think about that for a second, and think in terms of like what you've seen Bitcoin's price do as people wake up to this concept and they start acquiring Bitcoin at any price. And one other anecdotal thing I'll throw in, this lady helped do some Facebook ads, blah, blah, blah. She's very sharp. She said out loud, she said, I'm thinking about selling. She finally got it. She finally got the fixed supply thing, and she understands the issue with monetary debasement, which is what Bitcoin solves for. All this banking crisis stuff. This round of banking crisis has zapped a lot of people. A lot of people are waking up, like in the Lord of the Rings when Treebeard tells he's like, oh, it's not safe here. The Ents are waking up. The trees are. That's what's happening, and the trees are pissed. Okay, and the people are pissed. And you know what she said to me? I'm going to sell my house and I'm going to buy Bitcoin with it. And I almost fell out of the chair, and I was I
Yeah,
was I was just praying that she wasn't going to ask me, should I do this? I was just like, you do what you like, lady.
yeah, no,
But
no.
I
I
was
was just gonna
excited though.
say, no, no, no. That's a great point, and I always get real nervous when people because when you get this concept, you get really excited, right? And that's again, like we'll always say, look, you don't have to sell your house and buy Bitcoin. Don't like take some time to learn this stuff. Take 6 months, a year. This stuff is sometimes when you get it, it's like eureka. But then you got to understand there's so much more to learn. And I think the thing that people don't understand is that the volatility and the idea that yes, there's a fixed supply, but that doesn't mean the price is going to $200,000 tomorrow, right? There's so that's funny because but yeah, I did want to ask you a question though because I thought that was a great point. So take MicroStrategy for instance. They're going to issue more shares, right? And if you're a MicroStrategy holder, you're thinking, okay, well they've got a big position in Bitcoin. Do you think their position in Bitcoin offsets the dilution of the shares when they issue more shares?
And the short answer that I have is yes, because we know that, or I think it's a safe bet to say yes over a longer period of time, like another 4 years. As we get towards the halving event next year, ish, we got like 300 and some days, 360 some days to 370 days to 350 days until roughly the time that we'll get to where the block subsidy drops again by 50%. I think that as Raoul Pal talks about, he's like, we're at a macro turning event globally, and I think what's happening is a lot of these really complex trades, really complex other financial instruments and things are starting to unwind, and people are deciding that it's time to unwind some of these things, and this takes time. When you're talking, especially in the Forex market, where there's 5 trillion a day gets circulated or traded in Forex just by itself. We think the stock market's big, but it's 20 to 30 billion a day in the NASDAQ or S&P or whatever, or US stocks. It's like 20 in the billions, 20 some billion-ish, plus or minus several billion, okay, which is a lot, but that pales in comparison to the foreign exchange and then all the other derivatives markets that spin off or exist further down or further along the food chain. And I mean, think of it kind of like a food chain almost.
Yeah. No, I know you got to run here, but maybe we can pick up on this tomorrow because I saw that, and in context with what we were talking about today, I had this thought last night. I'm like, all right, so they're issuing more shares. They're most likely going to use the money to buy Bitcoin, right? And he's got, I saw all over Twitter that, people were, obviously trolling it and saying, oh, MicroStrategy's in trouble. They're going to have to sell assets. And, look, I don't really play in the stock market anymore, right? So my solution to this is to just buy Bitcoin and not worry about what MicroStrategy does. Other than I think it's interesting, and other than I think that if Saylor is proven right, I think that's a great precedent for other major corporations to adopt a Bitcoin standard in their treasury holdings. And there's a lot of other reasons why they would do this, but we can expand on this later. I know you got to run, man.
Well, yeah, I mean, we can go like another couple minutes, but let's bring it back around. So I think a good topic for tomorrow is to talk about MicroStrategy and the issuing of shares and why that's sometimes not a bad thing. But there's plenty of examples of how it is a bad thing where you don't get any notice and you learn, holy crap, Wells Fargo just issued another like 25 million shares to raise capital. Like, what the heck? And it only told their preferred shareholders, and they didn't tell like any of the common stockholders this was going to happen. That's the kind of stuff that I'm like that I don't like.
Well, yeah, and we can go further down this too, because this is something that I would like to understand better as well. So
circling it back around, this whole sell in May thing is from May to October. Is that the volume kind of just dries up, and the markets lack direction, and they lack the volume to drive price in one direction or another. And for people that are professional traders, professional speculators, who live in financial markets and that's how they make their living have typically taken it easy during these periods with the understanding that they'll make their money from October into the end of the year, into the first part of the next year. And because they preserved capital and took less risk during the riskiest time of the year, the odds of them being successful financially, meaning the bias that they have when they put that to work, will either be rewarded or they'll have to flip bias to stay solvent and stay in the game. That the rest of the time, as we cycle through into the next year, which is an interesting thing with Bitcoin, and I'll leave it with this: as we saw this, it looks like a lot of money piled into Bitcoin because it was on sale, and the fundamentals were still intact. Nothing changed about the network. A bunch of really bad actors got flushed out. A bunch of leverage got flushed out, and it was the juice was worth the squeeze. And we've seen the price move in the direction that it could, quite frankly.
Yeah, and so my takeaway from this is, like, look, learn about this, understand it. This was very beneficial for me to talk to you about this today. I kind of have a general understanding of what they were saying, but that helped me a lot in understanding the volume aspect of it. In terms of crypto, look, let's see, let's watch, if this applies over the summer, right? There's a lot of things happening in the world that could potentially drive volumes higher this summer in crypto. So, interesting topic, fun to learn about. Use it in your tool chest, and I think we can wrap it up there.
Superb.
All right. As always, nothing we say is financial advice. Do not do anything financially based off anything we say. If you enter these markets, you're doing so at your own risk. We are here for education. We want to help point people to other trusted sources so they can learn all things Bitcoin and crypto, along with the macro and potentially stocks too. But our focus is crypto, and we want to help you learn. So nothing we say is financial advice. We are here to educate and help people on their journeys. That being said,